Hi, this is Kathy with CallCathy.com. Love your home, love your neighborhood. I'm super excited today to actually meet here with Keith Brown of Intercoastal Mortgage. I've known Keith for many years. Actually, I had the opportunity to meet Keith on a transaction that literally was falling apart. This is a property in Arlington that had it was a condo conversion, basically an apartment building that was getting converted to condos. And at the time, FHA financing wasn't approved. And a local loan officer that my client was working with at the time, I was representing the seller. The financing had been falling apart, and the buyer's agent had mentioned Keith Brown of Intercoastal Mortgage, I think, can get the job done. And he sure did. As a matter of fact, not only did Keith go to Arlington County and get the FHA spot approval approved, but ever since then, I've added him to my list of preferred lenders, and he frequently is chosen as the number one loan officer of my client. So today I'm meeting with Keith. Keith, thank you so much.
Oh, sure.
I'm really excited for him to share all the information about what's going on in today's market. So many of you have probably seen in the news, in social media, a common question of everyone out there asking what's happening in our market today. So I'd like to start off with asking Keith one of these questions that has been frequently coming up. What are you seeing today in today's housing market, Keith?
So the market actually has changed quite a bit. For the better part of 2019, 2020, and 2021, everything was multiple bid. Everything was crazy. Probably go on the market if it was priced well, if it showed well. You get 10, 12, maybe up to 20 offers, and there's always going to be someone paying 50 to 100 grand over list price, waiving all contingencies. Now, of course, rates back then were sub 3. In the last 2 months, we saw rates go up over 2% in just a period of a little over 2 months. We moved from what was pre-Christmas in the upper 2s to January low 3s to now we're in the low 5s. And essentially every 1% increase in the rate reduces someone's purchasing power by $100,000. Folks that were buying townhouses for $600,000, keeping mortgage payments sub 3,000, are now having mortgage payments closer to 4,000. And that's affecting people's budgets. So we definitely have seen a slowdown in the number of contracts coming in. I was commenting to Christian, we had 3 contracts ratified this week. And of those 3, 2 were actually in prime locations. One was in City of Alexandria, one was in Falls Church. And in both cases, the homes were priced to market. They were actually comps that supported the values. They weren't overpriced or anything like that. But both had been on the market for over 2 weeks. Neither had any offers. They negotiated. In both cases, the prices were negotiated at lower price points. So we definitely have seen a shift. I've been talking to several loan officers here, and they're seeing the same trend in that, we're not seeing, not to say that there isn't multiple offers. I mean, if a house is still in a great neighborhood, priced under market, and shows great, it's probably still going to get multiple offers. But instead of maybe 10, 12, or 20 offers, it might be 2, maybe 3, or in these cases, in these homes, now these were both older homes, so they weren't, they need some work, need some updating. But even still, previous market, like for example, one of the comps that we were looking at, the home that sold in Falls Church, the 9 was listed for almost $1 million. There was a comp that sold just 2 weeks earlier, almost exact home, slightly better updated, had sold for $1,025,000. Our client got his home for $950,000. So that's just an example. City of Alexandria, something similar happened, that we are finally starting to see a shift where you're not seeing quite as many buyers. Sellers are not getting the multiple offers. And obviously, as a lender, that's great for me because I like it when my buyers don't have to write 7, 8. I'm sure as you do, you don't like having to write 7, 8, 9 contracts and always get beat out by some unbelievable money. The unbelievable money does seem to be dialing it back. And buyers are now getting a little bit more choosy.
So Keith, that's a good point, because what we're seeing is, even on the listing side, I list and sell more homes, and I do represent probably 70% listings and 30% buyers. I enjoy both. And what I'm finding as a listing agent, when you have 12, 15, 27 offers, it's a lot of data to go through. I think we're getting to a healthier market. I'd like for our market, of course, we're in such a great area,
Right.
and our market has continued to be a strong market regardless of dips and turns. Having been in real estate for over 20 years now, I've been fortunate enough to work through a down market and also work through two upswings. So that's, I believe that there are skill sets that we need to improve upon in working in both markets. Now, what are rates doing, Keith? You mentioned rates earlier. Could you elaborate a little bit more on what rates are doing?
Sure. So as I mentioned earlier, rate shot up has gone up over 2%. Uh, and the question is what the heck happened? How is it that we go from something that was upper twos, low threes to over 5% in such a short period of time? Obviously, everybody's aware inflation is a mess right now. We actually were hit 7% as of the year ended last quarter, March 31st. And everybody's frankly panicking on it. The Fed, saw inflation coming, and frankly, they didn't do anything about it. They finally realized they've got to actually step in and try to slow down the market. And the only thing that the Fed can do is raise short-term rates. Now, technically, what the Fed does and what interest rates do are not actually connected. The Fed doesn't actually control mortgage rates, but the Fed sets the tone and sets the tone for the markets. So when it became apparent the Fed was going to actually do some increases, the first increase they did was in March. They didn't do much. We're at rampant inflation at levels we've not seen since the 80s, and the Fed goes out and raises it 0.25%. The market, frankly, was disappointed in that. And so the Fed realized, we didn't do enough, and then in May, they raised it another 0.5%. And the May increase was kind of a surprise. That caught everybody off guard. But the reason they had to do that 0.5% is because confidence was being lost in the mortgage-backed markets, and rates were, the market was just in a tailspin. People are selling mortgage-backed securities. People are selling stocks. Stock market's down very sharply. And it's all feeding on one itself as basically everybody's trying to get out of their market positions and get into the safety of cash, which is cash isn't very safe when you have 7 or 8% inflation because you're losing money on that. But that's kind of set the tone. Now, since the Fed did the last increase, believe it or not, we've actually seen an improvement in rates the last 2 weeks. Conventional conforming 30-year fix, just say a loan amount under 647, hit a high of 5 5/8 with essentially no points. That got kind of scary because then we start seeing economists predicting, we might see 6% by the end of this year. But then the market, I think, had a chance to digest what the Fed had done, the fact that there is going to be more increases to try and combat inflation, and we are starting to see some effects in the marketplace where the economy might be starting to slow down finally and falter a little bit. And the rates have come back a little bit. The problem is, we'd be lying if we said we know what's going to happen next. Nobody knows. Back when the Fed first announced, back in January that, hey, we're going to start raising rates to combat inflation, most economists, Fannie Mae, Freddie Mac economists were predicting rates that were going to hit 4.25 by the end of the year because that was 1% over kind of where they were at in January, and they were building in a 1% increase by the Fed. Obviously, they missed the boat on that. No one saw them in the fives, and that's where we're at right now. Some economists are predicting that with the further Fed increases, further slowing down the economy, we might start to see rates pull back and get back into the upper fours. Others are saying, well, if we don't get some decent improvement in inflation, if we're still running at this 7% annual inflation, if we still keep having shortages of gas prices, gas getting up close to $5 a gallon, if we're still having problems getting semiconductors to put into appliances and cars, and there's not enough cars on the road for people to buy, prices will go up, and that will put pressure on rates to go even further. So it's, one hand, I think if I was predicting, I'd tell folks, you're as likely to see maybe 4.875 as you are to see 6%. It's going to be somewhere in that range. We just don't know where. One thing we are confident on is in the future, things are cyclical. Every 4 years, we go through periods where rates jump up, into the upper fours, and they would drop back down to the mid threes. We did that going back to 2008. Every 4 years, we'd get up into the upper fours. They'd be short-lived. They'd drop down to the threes, stay there for a year or two. Probably about 2 years, we're going to see rates cycle back. So what I'm telling clients right now when they're buying homes, don't sweat the fact that you're sitting on this, 5.5% interest rate or 5 1/8 rate or whatever, because chances are in a year or two, you're going to be able to refinance that. Probably going to refinance it down to the low fours, and who knows? If we get into a solid recession, the Fed has to start dropping rates, we could easily be back down in the low to mid threes, and you're refinancing again. So bottom line is you're buying a home, you're living in it, it's your residence. Values probably are not going to come flying back despite what we've seen the last few weeks. we probably are going to see, rates come back. The house will be more affordable if you got to stretch yourself a little bit now to get it.
Sure, sure. And Keith, how much does a buyer's purchasing power go down for a 1% increase in rates? How does
So
that affect the buyers?
So basically, about a 1% increase rate erodes a buyer's ability by about $100,000. That's a lot. When you, like I said, we do a lot of townhouses in this $600,000 price point. I work with a couple builders that are selling townhouses around 600,000, and folks were very comfortable with. A lot of these are first-time buyers. They were comfortable with mortgage payments around $2,900 to $3,100 because a decent rental is about $2,800 to $3,000 for a decent townhouse rental. Now this is out in Gainesville. It's worse here in Fairfax. This is out in Prince William County. All of a sudden now these guys' mortgage payments, now they're getting $4,000 because of the 1% increase. That severely impacts purchasing power. Again, they'll probably see an improvement when rates start to come down, but with that 2% increase, it's really shocked a lot of folks.
Great. And are more buyers migrating towards ARMs? I'm hearing a little bit more about ARMs and
Right.
different loan products.
So this is the problem with the ARM market right now. When I say an ARM that has an initial fixed term of 7 years or 10 years, a good alternative to the 30-year fix where you still get a lower rate for a fairly decent period of time, long enough maybe to ride out the current high rates, refinance to a fixed rate. The problem with ARMs is that for the average buyer that's putting less than 20% down, think of our first-time home buyers or even our move-up buyers but don't have quite the capacity to do 20% down. ARMs aren't available to them, at least not at rates that are attractive. Your standard ARMs, your standard loan products go through Fannie Mae and Freddie Mac. That's where our 30-year fixed money comes from. Back in 2008 when the market collapsed, they got turned off on ARMs. So essentially, they don't back ARM products. So there's not any decent ARM rates for buyers that have less than 20% down. Now, buyers that are buying in the upper price points that I would consider upper middle class to wealthy are having the ability to put 20% down. They can get what we call portfolio ARMs, which means they can get adjustable rate mortgages that are held individually by banks that are not sold on the open market. And these ARM rates are incredible. For example, we're backed here at Intercoastal Mortgage by a bank called MVB Bank. We've been offering a 10-1 ARM as low as 4.25%. But you've got to have 20% down. You've got to have great reserves. You've got to have great credit. You have to have low debt ratios. So a well-qualified buyer, they're going to look at that ARM and say, why should I pay a 5% fix if I can get an ARM in the low 4s? For our more average borrower, putting less than 20% down, maybe stretching a little bit on the debt ratios, maybe has a ding or two in the credit, they're not going to be able to get an ARM. But if you are qualified to get an ARM, there's some great options out there.
That's good to know. That's great to know, Keith. And are we seeing a slowdown in buyers getting pre-approved?
So that's kind of interesting. Part of me wants to say yes, but when I actually looked at the data today, we haven't. We're still pre-qualifying borrowers pretty much at the same clip. Now there's two classifications of borrowers I'd say we have out there. We have our new construction business, our builder partners, and then we have our what we call spot business, which is our realtor referrals. The realtor referral pre-quals have stayed the same, and if anything, they maybe have actually increased slightly. The builder side of it has come to a screeching halt. So we think part of what's happened is the builders, when the market was really hot, they could basically every month raise their prices. And I think the builders have raised their prices to a point where they've hit saturation levels. For example, again, I won't name the builder that I work with, but when they opened their project just a little year and a half ago, they had these properties priced in the upper 4s. Now they're priced mid-6s. There was no reason to raise the price that much, except the market allowed for it because they had a wait list. And then one day, there's no wait list. And they're overpriced probably for the market. But they have people that have wrote contracts at those higher prices, because remember, it can take 6 to 8 months to build a house. So now they're in a rough situation, whereas your spot buyers, think of the ones we mentioned earlier, where clients are finally able to buy these homes in great neighborhoods and maybe not compete against a bunch of offers, maybe able to actually negotiate. They're not in that same position because they can still get market value on the house because market value can change. So it's a little bit different. It's a great time if you're a realtor, I think. You're going to have, I think there's still a lot of people that still want to buy homes. But if you're a builder, you're in a tough situation. You can't just arbitrarily drop your prices because you have people that wrote on those. But at the same time, you might be now over market on those.
That is great information, Keith. And have you seen fallout and buyers qualifying or buyers pulling out of the
We
market
have.
after having been pre-approved?
We
What's
have.
happening there?
I mean, again, it's buying, most buyers when they're buying a home typically don't go to the ultimate limit of what they can afford. Oftentimes, like when we're pre-qualifying buyers, a buyer says, I'll tell a buyer, okay, I want to buy a $600,000 home, and I do the qualifying, and I say, oh, you're well qualified to 700, maybe 750. Now think if that buyer qualified at 3%, and all of a sudden the rates are at the 5%, all of a sudden they're looking at that price range, that $600,000 payment they originally thought, now it's much higher. So we have seen a large fallout in that aspect. Some buyers, especially first-time buyers that just don't have the wherewithal to cover that, have dropped out. Other buyers are just looking at, like we discussed earlier, to the standpoint that, okay, I'm going to have to sacrifice to get the house with the hopes that in 2 or 3 years I can refinance and get that payment to a more affordable level. One thing about our area, we're not a blue-collar area, we're a white-collar area. So folks tend to be highly compensated and incomes tend to keep pace with inflation. So a lot of our purchasers are also looking at it from the standpoint, yeah, I'm paying higher for a rate, but yeah, my prospects look good for higher income, and I do hope that I'll be able to refinance. So again, it's quality of buyer. The first-time buyers, absolutely, there's been a huge hit to that market. Your higher end buyers, which more so of who you work with, your buyers that are selling a home, moving up to a much more expensive home, they're looking at the payment and being pragmatic about it. Yes, I'm going to have to readjust my budget. In the end, I can afford it. In the end, it's not going to kill me to take this higher payment. I need the house. My family's growing. I've got to have this.
Okay, great. And are there predictions for prices to collapse or fall short sharply with the higher rates?
So we don't have that. It's real interesting. Now, you mentioned you lived through the down market, I think, between basically starting in 2007 all the way up through about 2000, when the market collapsed, when we had
Yes.
the no income verification loans, the subprime, if you have a heartbeat, I can get you a mortgage.
Yes, if you breathe.
You
Yes.
know, literally, if you
Literally.
could breathe. I once did an $800,000 loan for a lady who was a baker at a Food Lion under a no ratio loan.
Unbelievable.
She couldn't. She could no way she could afford paying. It was blind, rampant speculation. So when that market collapsed, people could not afford their mortgages, and the result, values imploded because people just abandoned properties en masse. Everybody was on the bandwagon. I'm going to buy, flip it, make $100,000, and I'm going to keep flipping homes. They had investment clubs. So fast forward to now in this market, and while we are seeing a lot less demand, the fact is anyone that's bought a house since 2008, their income's fully verified, they could afford their mortgage payments under the current rules. There's no such thing as stated income loans. There's no subprime mortgages out there. There's no 100% financing. Everyone that's bought a house has put money down. In addition, values have appreciated so sharply. Anyone who bought a house, for example, between 2016 and 2020, anyone that bought a house in 2016 had over 20% equity by the time when we were doing refinances in 2020. Because I was taking people that had mortgage insurance in 2016 and dropping it in 2020. Anyone who bought a house in 2019 to the beginning part of 2022 saw their homes appreciate almost 25%. The appreciation skyrocketed.
Amazing.
So that's also leading to the other part of it where you don't have a lot of people selling their homes that normally would have sold because they either bought or refinanced to a rate that's in the 2s. Now we're in the 5s. And the home that they bought has appreciated 20%. If they want to buy, they have to build into the fact, well, if I want to buy up, I'm in a townhouse. My townhouse I bought for $500, now is worth $625. I want a single family, I got to make a jump to $725. My 2.5 rate now is going to be 5.5%. My mortgage payments are going to more than double. So they're not selling their homes. Hence, there's still very limited supply. And if there's limited supply, but there's still limited buyers, the market finds equilibrium. But you're not going to have people abandoning their homes. They could afford the payments that they got. They have equity in the house if they do choose to sell. And the market has ample room. If someone, for example, like these homes, that the one that sold for $950, well, they bought their home in 2019 for $775. They have a ton of equity in the home. Who cares? They maybe didn't get the $1 million that they were hoping for, which they would have got $1 million 2 months earlier, probably.
Yes.
But they're not exactly bringing money to the table. So we're not going to see an actual collapse like we did in 2008. There'll be a slowdown. We might see a 5% haircut on some of these valuations, but it's not going to be a complete free-for-all drop in the marketplace. Values are going to remain fairly stable.
And thus we're fortunate that we live in the area that we live and work in.
We're immune from so much of the stuff that the rest of the country goes through because, again, jobs are relocating here. Amazon, second world headquarters, the federal government here. IT is rapidly moving. A lot of the major IT companies are moving here to get closer to the government, closer to Amazon. Businesses are relocating their corporate headquarters here. Again, get closer to the government, more of a say of what the government's doing. And these are all very high income jobs. So we're just, in some aspects, there are areas I think that will see certain decline in values, areas that are heavily, contingent on like second homes or investment financing and speculation. They'll probably see much more of a cutback. Here, the bottom line is, sure, rates have gone up, but our average incomes are between $200,000 and $300,000 a year for a family of two that are purchasing inside the Beltway area. They're not going to care for rates 4 versus 5 versus 6. They can still afford their mortgage payment.
Sure. And what do you see happening with baby boomers? Are they selling and moving out of the area and purchasing? And are you having some experience with that? Or are there more millennials that are buying? Or who are the buyers that are really out there right now?
So not seeing a lot of, millennials, so as far as buyers that I would define as being in their late 20s maybe, we're not seeing many of these buyers. Surprisingly, so they just don't come across my desk. Most of my buyers typically are the ones that are selling an existing home and moving up because now they have kids. So I would say early 30s are those. The baby boomers are interesting because one thing about baby boomers, they want to be near their families. And well, the thing is, their families are here because they raised them here and their kids have high-paying jobs here now. So we are seeing baby boomers sell their big homes, but we're seeing proliferation. Proliferation. We're seeing proliferation. Yeah, tongue twister there, right? We're seeing a proliferation of these 55 and better communities that offer everything from apartment style living to townhouses with elevators to the big single families. But they're in these 55 and better communities. And we're seeing a lot of buyers, a lot of the baby boomers selling their homes and moving into these communities. There's huge demand for these communities, but they're not necessarily moving out of the area. Obviously some are, but a lot of them are choosing, okay, I've got this old rickety house from the 70s or 80s. I'm going to buy into this brand new development where people are just like me, but I still have a beautiful home. I'm in a great community. I just don't have all the maintenance and everything that I have with my house that I've lived in for the last 30 years. So that's what we're seeing is they are selling, but they're not exactly leaving the area. They're just buying in one of these 55 and better communities that are right here local.
That's great information. And just from the real estate standpoint, these owners have owned for the last 20, 30, 40 years. And even if the market does go down slightly, they're still benefiting.
They have equity. They're not as concerned. And like I said, their house since, essentially, if you take a home from 2016 to early 2022, you're looking at between 30 and almost 40% appreciation in homes if someone bought a home in 2016. That's how insane our market was. Because literally starting in about 2017 is when we started seeing the multiple offers. And really, we've been on this train since then. It's funny, it slowed down a little bit in the pandemic, and then people realized, wait a minute, I can work at home. I hate my home because now I have to work here. I'm going to buy somewhere else. And the market exploded again. And it's now, just now, starting to get a point of equilibrium. I wouldn't say they're falling necessarily, but we're seeing some equilibrium in the market.
Well, that actually is great because I think that it sets the market and the tone again, and it makes it more possible for these buyers to actually buy a home, and sellers are still in a great position to still
They are.
sell and realize the equity that they built over all these years. And so, Keith, I really appreciate all your time today, and we may have a few other things to discuss, but I wanted to just thank everyone for watching
Sure.
us today. And Keith is a very well-known loan officer with Intercoastal Mortgage. Intercoastal is a local bank here in Northern Virginia. And Keith, if you'd like to share anything about
Sure.
Intercoastal, I would like to just share that I'm very fortunate to have the opportunity to work with Keith. Whether it's a move-up buyer, a first-time home buyer, or a buyer coming here from out of the area, Keith offers very competitive rates, excellent customer service, and we've had a lot of happy clients, and we're really thankful to be working with Keith at Intercoastal.
Yeah.
So anything you'd like to share?
So Intercoastal, in its original founding, was founded back in 1987. So we've been around forever. I actually joined Intercoastal in December of 1995. And it's rare for a loan officer to be with the company for that length of time. So obviously, I like what we do here. What's important is that we're actually one of the largest lenders by volume when you look at the Northern Virginia, D.C. metro area. Last year, I believe we closed, I might not be exact in this, but I believe we closed about $4.4 billion in loans last year, which is an insane amount of business. But we're not a national bank. This is our footprint here. We also have some satellite offices in some of the southern states, but this is the lion's share of where the business comes from. So while the average client has never heard of us because we don't advertise, our business is 100% referral based from realtors like yourself, from builder relationships we have. We close and do everything inside this office. Our underwriting's here, our processing, our funding's here. The money comes from us. We control the process start to finish, and the result is we close on time, we close without drama. And that's why realtors refer all their business to us, and that's why we're so well known in the community. It doesn't hurt that our rates are really good.
No, rates are excellent, and the drama we can definitely leave.
Leave at the table.
We can leave it at the table. So yes, absolutely. I'd like to say that when you're working with Keith at Intercoastal, it's kind of a non-eventful closing because everything is done up front. If you are looking for a pre-approval, Keith will collect all of this information. He'll have expectations of paperwork, forms, information that you'll have to supply to him so he can do a solid pre-approval.
Right.
And I'd have to add to that, just as a local listing agent, when I run into a Intercoastal pre-approval, I tend to really know that I favor those simply because I know that Intercoastal is a strong local bank. And in reverse, if we're representing a buyer, and I mentioned that I'm working with Keith Brown at Intercoastal Mortgage, typically our offers are actually many times chosen because these listing agents out there actually trust Intercoastal. They have an excellent reputation for the delivery.
You're not going to have a last minute, oh, we can't do this, oh, we need to delay settlement. We close on time, we close without drama. That's all it is.
I think also in addition, when you do a solid pre-approval, these buyers are taken care of so that we're not doing some of these loans that are,
Right.
I've been very fortunate that a lot of my clients, I haven't had a lot of
Right.
clients have to experience a short sale or a foreclosure my whole career, as a matter of fact. And I pride myself on that fact that I work with great loan officers. We really look out for our clients' best interest, always. And I really appreciate working with a loan officer such as Keith
Sure.
that does the same. Anything else that you'd like to add, Keith?
I think we covered everything today.
Thank you so much. Thank you. Really appreciate your time.
You're welcome.